Wow. I mean, if you were watching the market today, you know exactly what I'm talking about. Whiplash doesn't even begin to cover it. We saw a terrifying plunge, followed by an explosive rally that clawed back a huge chunk of the losses, all in a single day. So, what on earth just happened? That's what we're here to do. We're going to break down the absolutely extraordinary events of March 5th. We'll dig into this historic rebound in the Asian markets, and more importantly, try to figure out what it all signals for the future. Okay, first things first. Let's just look at the raw numbers because they are absolutely shocking. After days of just pure panic selling fueled by all that geopolitical tension, the market didn't just find its footing. No, it completely exploded upwards. This was genuinely one of the most dramatic reversals on record. Just look at these numbers. The sheer scale of this reversal in the Korean market is staggering. You've got the KOSPI surging over 9.6%, and the tech-heavy Kosdaq, it rocketed up more than 14%. Seriously, this isn't just some little bounce back. This is a powerful statement, a massive V-shaped recovery that erased a huge chunk of those painful recent losses in a single session. So the big question is why? How does a market swing from complete, total panic to absolute euphoria in less than 24 hours? Well, the answer lies in a really fascinating, powerful mix of psychology, government policy, and just pure, unadulterated technological optimism. You know, to really get what happened today, we have to talk about a concept from the legendary investor George Soros. It's called reflexivity. And the core idea is actually pretty simple, but it is incredibly powerful. It says that market prices don't just reflect reality, they actively create it through a powerful feedback loop. And today was a textbook example of this in action. It's pretty amazing when you break it down. So, step one, bad news hits, right? The geopolitical crisis creates this perception of extreme risk. So what happens? Massive selling, pushing stocks way, way below their fundamental value. But then, and here's the magic, the loop reverses. The perception flips. Suddenly, everyone's thinking, wait a minute, these prices are an incredible opportunity. That new belief fuels a buying frenzy, which pushes prices up, which in turn reinforces that new positive belief. And boom, you get a self-sustaining rally. But listen, it wasn't just psychology. There were some real powerful, fundamental drivers at play. Three big ones. First, you had government policy. This corporate value-up program genuinely made Korean companies a much more attractive buy. Second, the AI optimism is absolutely real. I mean, huge profit expectations sent giants like Samsung and SK Hynix soaring. And third, you combine those two factors, and what do you get? A record-breaking flood of foreign investment pouring into the market. It was like pouring fuel on a fire. Okay, so that's the story in Korea. Now let's pivot and take a look at China and Hong Kong. Because while Korea was just on a tear, the story over there was, well, a lot more nuanced. It was really a tale of two very different markets. It's super interesting when you put them side by side. On the mainland, the rally was almost purely policy-driven. The government announced this huge stimulus package, and investors responded with confidence. But in Hong Kong, it was a totally different ballgame. That market was driven by company-specific news. So while AI-related power companies surged, uncertainty around giants like Alibaba actually dragged the tech index down. It's a perfect illustration of how government action can move one market, while corporate fundamentals drive another. All right, so after a day of historic volatility, the only question on everyone's mind is, what happens now? Was this just a crazy one-day wonder, or is this the start of a whole new trend? Let's take a look at what the data is suggesting. So this timeline basically lays out the forecasted trajectory. Think about it. February was that period of a gentle, optimistic rise. Early March was the sharp, crisis-driven drop we'd all just lived through. But the key thing here is the forecast from this point on. The models are pointing to a strong, trending upward phase, one that's driven by that powerful combination of the AI theme and just solid corporate earnings. And here are the specific targets. We're not just talking about small gains. The models are projecting some very significant upside from here. The KSPI is forecast to have a potential upside of over 16%, with the tech-focused KSDA Jack projected to climb almost 21% by the middle of the year. And look, even the more cautious forecasts for China and Hong Kong are still showing some pretty healthy potential gains. Now, this bullish forecast isn't just wishful thinking. It's actually supported by the technical data. 4 key indicators are all pointing in the right direction. Momentum indicators are flashing a strong buy signal. Buyer strength is high, but not yet at a level that suggests overheating. Trend indicators show that this upward move has real strength behind it. And maybe most importantly, we're seeing a powerful inflow of new money into the market, which suggests the big investors are betting on this rally to continue.
So, given this new reality of high volatility but really strong upward potential, how should you actually navigate it? Let's walk through a disciplined, quantitative framework for thinking about this.
A disciplined strategy here really has 3 parts. First, you've got to find the leaders. This means focusing on hot sectors like semiconductors and filtering for stocks that show both strong momentum and have a lot of new investment flowing in. Second, you have to manage your risk. This involves using strategies to protect your portfolio from those inevitable dips and pullbacks along the way. And finally, you trade the cycle. History shows these cycles have peaks, so the plan is to gradually take profits as we approach the middle of the year rather than getting greedy trying to time the exact top.
And this brings us right back to where we started. That quote from George Soros just perfectly encapsulates the lesson from today, doesn't it? The market's perception was extremely wrong during the panic, and it was in that very moment of extreme wrongness that today's massive opportunity was born.
So we're left with this crucial question. Was today just a frantic rebound from a market that fell way too far, way too fast? Or are we witnessing the very beginning of something much bigger? A whole new economic era powered by AI and fundamental policy shifts. The early data suggests it could be the latter, and that is a story we will be watching very, very closely.